Good afternoon or morning. I'm Wayne. Welcome to my world. This is the first of hopefully many of our podcasts designed very simply to help you have an exit strategy and understand the power of real estate investing as a wealth building process in your real estate career. There's a lot of things to do, a lot of things to answer, and hopefully make sure you leave here a bit smarter than when you walked in to this podcast. A couple of key things to remember. I consistently hope every single one of you have already started a real estate investment career, but if you have not, I suggest either one of two options this year. Buy 2 properties every year for your retirement, or buy 3, flip 2, and keep 1. I'm open to questions. I'm open to comments. I'm open to sharing what you feel is the most important to you in the process. Couple things. As you are listening, as you're thinking, as you're feeling about wealth building, maybe there are some phrases you want to share with me about what you know already to make sure you're on the right track, or you wonder why, or you heard that, or what's your burning question. So I'm open to any of that at any time. The goal is very simple. I don't know what you don't know, and I know what I'd like you to know, but I have to make sure that what I want you to know and what you want to know are the same thing. Real estate investing is an amazing process for wealth building. We are in one of the most turbulent times many people have seen in 40 years. I mean, you're aware of this, I'm sure, in your markets. There is inflation at a rate that we've not seen since 40 years ago, 1982. And so as I think about that and wondering what happened back then, there's a quote from Alexander Tyler that's so important. Those who don't understand history are bound to repeat it. So what happened in 2006 when the Fed raised rates 17 times? How did it impact investors? How did it impact homeowners? But wealth building centers around some basic philosophies and mindsets. And so first things first, if you have something you want to share, please interrupt and just ask. Because what you need to know is probably what somebody else wants to know, and vice versa. So before I begin, a little bit of some specifics, any burning questions related to building wealth using real estate? Okay. The goal should be pretty simple. Over the time we spend together on these Fridays, you're going to learn 10 commandments for future financial freedom. You're going to learn, hopefully, the process to make sure every single month you run out of month before you run out of money. Here it is, towards the end of February. Short month, but some people may have some problems finishing up the weekend because they ran out of money before they ran out of month. My email, my phone number is there. It's also scrolling across the bottom of the screen. I would love to hear your thoughts, comments, and questions to respond to every single one of them as we leave here today. But think about what causes people not to build wealth using real estate. What causes people not to build wealth using real estate? And we're going to go through maybe some of these. We won't get done this week. We'll get done in the future. But the bottom line understanding of some basic economic principles is critical. If you've taken a macroeconomics course, you learn some of these. But here we are. We are in a stage of transferring wealth. It's inflationary. It wasn't that long ago. It was recessionary. And I'll share a simple thought process. In real estate, ORs always do or give to EEs. Grantors grant to grantees, lessors lease to lessees, mortgagors give to mortgagees, vendors sell to vendees. Well, in wealth building, during inflation or recession, Wealth transfers from one group of people to another group of people. You want to make sure, whether it's the next year and a half or in 5 years, you are the transferee of the wealth instead of the transferor of the wealth. Because we're going to have wealth transferring. Right now, we have too many dollars chasing too few goods. That means more people have more money, which means tenants are going to expect increases in rents, which means your cash flow should get greater, but you'll have higher expenses. So all those factors come into play with real estate as what I call the ideal investment. And you'll see why I've got those 5 letters with a period after them. Because this is an acronym for realizing that real estate is not necessarily the best investment, but it's the ideal investment. It's all based on a very simple mindset. First of all, why do I feel and why should you understand why people don't build wealth using real estate? And there's 5 steps or 5 processes or 5 links in the chain, whatever you want to call it. They need to be overcome, or you never become that person who's buying 2 properties a year. I have the privilege and pleasure of managing properties I started buying over 40 years ago, at least 2 every year I've been a realtor. Right now, my exit strategy is to be able to use that portfolio to have a lot of passive income. In fact, I would say your goal, is sooner the better, is to find a way to make your passive income larger than your earned income. You've probably heard that from many different people. Our good friend, Grant Cardone, says that so many times, and it's so true. I've been saying it for years. How do I get my passive income greater than my earned income? And then we got to talk to make sure you know the advantages of real estate with unlimited passive losses. We as realtors have the unique opportunity to utilize the tax laws and have unlimited losses against our income. There should be no reason why you are not taking advantage of that as a realtor and a real estate investor, because other investors don't necessarily get that unlimited passive loss. They are limited to $25,000. Think about that. So let's take the first reason why people don't invest in real estate. It didn't occur to them. I would imagine if you just spent 30 minutes in your local MLS right now, you could find several properties that would meet your investment criteria. And the most important investment criteria that I have found for residential real estate, as well as many commercial properties, but definitely residential, is towards the bottom of what you see on the screen, the capitalization rate, the cap rate. So we're going to spend some time talking about cap rate and what you feel is a good cap rate for you. And that's individual. Somebody's happy with an 8% cap rate. Somebody wants 12. Somebody will take 5. You might take 3. You might want 13. We don't know, but we do know in inflationary periods of time, the cap rate changes drastically compared to what it did when we had a recessionary time. So let's put things in perspective. The first reason why people don't build wealth, let's get those out of the way. It didn't occur to them. They had no awareness. My goal is to make you more aware of things like the opportunity cost of money, why equity could be an ego trip in real estate investing, the inflation unemployment trade-off, looking at not just real estate, but other hard assets. I'm back on a process that says, hey, maybe, just maybe, we should look at things like silver, gold, diamonds, as well as real estate, and maybe even non-perishable food storage, because food prices are skyrocketing. So those are what are called hard assets. In times of inflation, we need hard assets, and definitely real estate is a hard asset. The 1031 exchange should be something you look at as you start building your portfolio. So all the time you're doing this, you can keep trading up, trading up, trading up. according to the IRS guidelines for the 1031 exchange, sometimes called the Starker exchange, because of a man named Starker who challenged the IRS to make that happen. And right now, we are at kind of a crossroads. I am very worried personally, and I think you should support the Realtor movement to make sure we don't lose the 1031 exchange. There's a lot of activity for the first time threatening the 1031 exchange as a tax benefit to real estate professionals. If you're following that, congratulations. If you're not, please take a moment, because it's going to have a big bearing on your future in real estate investing. Also, many people are not aware of the fact that you can have real estate in a self-directed IRA. So maybe some of your clients can benefit from this as well as you. And then we'll take a look at a few other things, like the two rules, the Rule 72 and the Rule 115. This is why you need to be aware of this. See, your awareness on all these areas says, I'm going to be much better now that I've picked these ideas up and used them. Many of you know the Rule of 72s, but do you know the Rule of 115s? Realize the power of awareness. It didn't occur to people. They weren't aware. The second reason that this doesn't evolve into a plan for many people, once they're aware of these things, they didn't decide to do it. They didn't set the goal to buy 2 a year or 3 a year. Or my other philosophy, buy 3, flip 2, keep 1. I don't really care how it fits into your schedule, but you need to set the goal, a goal that's practical, attainable, and reasonable for you in terms of the investment of money you want to do. Understand that once you're aware of it and once you've set your goals, then the concern you have is very simple. You can't put it off. Your commitment to do this on a regular basis will make the difference in wealth building. And once you start getting the first one, then the second one, then the third one. So if I saw you in 5 years, the first question I would ask you, do you have 10? If I saw you in 3 years, do you have 6? If I saw you in 20 years, do you got 40? You need to keep building your portfolio of properties you like. They don't have to be single families. They could be duplexes. They could be condos. They could be small apartment buildings. You might want to go commercial. Either way, these links in this chain tie together. I've got to be aware, I got to set my goals, and I got to commit. And the fourth reason why real estate agents do not build wealth investing in real estate to create passive income, to be active, is based on the sad fact that we are a society that cannot delay instant gratification. We want something else instead. Someone just did a study that a person at age 18 who spends $5 a day at coffee shops, whether it's Dunkin' Donuts, whether it's Pete's, whether it's Starbucks, by age 30, they would have over $20,000, even at a low interest rate, to use for real estate investment, first home or a rental property. So that's the fourth reason people can't instant gratification. The fifth reason you don't build wealth is you don't understand the time perspective. And that's where the Rule of 72s comes in and the Rule of 115s comes in. We're sitting here with inflation that we just heard is 7.5%. At 7.5%, if that continues, in roughly 9 years, everything will double. That $100,000 property becomes 200, that 300 becomes 600. So here's the thought, because the L in ideal is for leverage. Let's pretend you have $100,000. You could take very little risk and buy a $100,000 property and pay for it all. You've got no mortgage loans, You have a lot of cash flow. But if inflation continues at 7.5%, what if you went another way? What if you use that leverage that's so powerful in real estate investing? Instead of buying one condo for $100,000, you bought 10 condos and put $10,000 on each one and borrowed $90,000. Now you've got 10 condos, but you have a $900,000 chunk of mortgage loans. But every year, inflation continues at 7.5%. Even after the first year, you've made $7,500 on the $100,000 if you paid in full for the condo. But your 10 condos have earned you 10 times that because the inflation is 7.5%. So if I'm making $7,500 on one, I've got a $75,000 profit because of inflation. The appreciation went up $75,000. I also have large number of tax deductions for the interest I paid. I'm making my money work for me instead of me working for the money. And so other people's money is one of the reasons why real estate investing can be easier than you feel or think, because you get to use other people's money. I can go to any bank, BMO Harris, Chase, Citi, doesn't make a difference. If I want to borrow, let's say $200,000 to buy a property, I'm going to put down $40,000 and buy something for $240,000, $200,000 mortgage. It's a pretty good chance they'll give me a loan. But I go to that same bank and I say, hey, could I borrow $200,000 to buy some of your stock? I doubt if they would sell me any of their stock, because I can't leverage many other investments like I can real estate. I can use other people's money. And so the equity is valuable, but the ego of the equity is causing me not to keep my money moving. And that's why 10 condos with $10,000 a piece in the long run has much more advantages than one condo at $100,000. And you can leverage those. Now we're going to talk some stories and do some things. The bottom line is there's a lot of different ways to do this, but just remember this. You've been aware of a few things. Now you've got to set some goals. Then you've got to not put it off. Then you can't delay instant gratification. Just stop doing something else and get that real estate investment as your highest priority activity between now and, let's say, the end of March. There should be no reason why you can't find one property that could be your addition to many you have already, or if this is your first property. And I really find that goals are critical. But I also found something else, not just in real estate investing, but even in real estate growth of your business as an agent. It's easier to make excuses than to make goals. So there should be no excuses after today to get ready, get set, and then go into an investment. Whether you already have several and you're going to add one more, or this is your first. Right now, money is losing value. The opportunity cost of you using money when you could be the next best thing is investing could have some value. So, as you think about this, what is? You can't think what was, you got to think what is. Because we are in a different economy than we were just a year and a half ago, before COVID, 2 years before COVID. And the key is, don't worry about what was and start thinking more about what is, and then realize something else, the 10 most important words in the English language. If it is to be, it's up to me. You don't have to do my goals. You can't do my goals. I'm buying my properties this year. Are you buying your properties this year? I'd love to help you. You've got my email and my phone. If you want to talk specifically about a property, call me. We're all in this together. We're all part of a great organization. We're all realtors. And so why not make sure that your passive income gets closer and closer and closer to being greater than your earned income? Take the tax benefits that you'll get with income property. Take the tax benefits you'll get by filling out your tax returns properly, whether you use an accountant or not. You know, those of you that like to gamble, whether it's at Vegas or some other casino, know that if you play cards, there's a pretty good chance you almost always win with aces. If you've got a lot of aces, the odds are pretty good you're going to be a winner. The odds are in your favor. And in real estate, you as an agent and as a real estate investor will win with aces. I've looked at a lot of people in different parts of the country, out of the country. I've looked at people who started investing with something very small. Some people are very large in terms of their investment portfolio. Their wealth is different. I'm never going to suggest what a wealthy person is financially because it varies. But I do know this. If you're filling out Schedule A, Schedule C, Schedule E, and Schedule S, ACES, you are indeed a wealthy realtor in proportion to other people in your market area. You itemize deductions, Schedule A. You got profit or loss from business corporation, Schedule C. And then Schedule E, rent and royalty income. And then Schedule S for self-employment taxes. You win with aces. If you are filling out 4 forms and keep getting those forms to be working for you, instead of you working for them, you will find that wealth just happens. In real estate, that Schedule E is definitely is the best one because we have these 2 artificial expenses that we don't use to calculate cap rate that make a big difference in showing losses on paper. Interest expense and depreciation. There's the D in ideal. See, very few other assets will depreciate the same way real estate does. Example, and I'm thinking right now, we're into this maybe about 25 minutes, and some of you may be overwhelmed right now. And some of you, you're underwhelmed. I know this. So maybe I'm just reminding you if you're underwhelmed, but maybe I'm getting you excited if you're overwhelmed. And that's my goal, either way. But I do know that a very simple rule of thumb, a Wayneism, as many people call them, is that for every $1 million worth of real estate buildings you have of any kind, could be 4 $250,000 properties, could be 10 $100,000 properties, could be one $1 million property. Doesn't make a difference. You can write off $36,000 of artificial expense called depreciation. As you keep building your portfolio, by the time you get to $3 million, you can write off over $108,000 of income from either the income properties and or your real estate profits in selling. So if you've got several properties that just break even, all the money coming in covers all the expenses going out. So you show no taxes on your Schedule E for your income property. You have no tax liability. That $108,000, because you own $3 million worth of properties, could be written off against your income as a realtor. And I could show you, and maybe will in future events, where a person could easily be pulling down $140,000, $150,000 a month in commissions and with depreciation from their buildings and taking the basically tax avoidance strategies that I would suggest you do as a realtor. Many people miss those. Remember, you don't evade taxes, you avoid taxes. It's your constitutional right to avoid taxes like poison. Evading taxes, that does pose some problems. But nothing ever happens till something happens. It's called an audit. And I get audited almost every year, so I pretty much know the audit game very well. I almost like to schedule my audits because I'm happy to share what I do because I'm doing it according to all the laws I'm aware of. And one of those laws is passive losses. So that $108,000 loss, coupled with some other deductions of my $150,000 income, may make me pretty close, if not totally close, to being able to pay no federal income taxes legally. Now, if you want to get into other aspects of investing or big time investing or syndications, that's beyond where I'm at right now with you. I just want you to start with something you're comfortable with. What's in the MLS that makes sense to you according to the capitalization rate, and any other things you're looking for to make your first or future income properties work for you. So, I'm not sure if you want to shout out a question. I'm not sure if you want to just talk to me later, but this is the foundation of real estate investing. First of all, know the 5 reasons why you haven't built wealth the way you should, and then take a look at some of these topics in more detail. You can Google some of these. You can just go online and see some of the tax benefits for real estate professionals. Many of those may be lost in the next couple of years because obviously our government's looking for ways to increase taxes, and the realtors are being looked at in a hard way for investment strategies. One of my good friends, Dan Wagner, is traveling the country trying to convince legislators and other realtors around the country to make sure we support any candidate who is not wanting to abolish or change the 1031 exchange. Now, is there some math to do this? Yeah, not really. I think probably 99% of everything I own was based on one simple formula, the capitalization rate. So I'd like to share an example, and you're welcome to make some notes and write things down, and if it triggers some thoughts, please share. But I'd like to remind you that this could be the most powerful formula that could get you through the majority of your real estate investments as you begin this process. Now, there's other things people can look at: internal rate of return, gross rent multipliers, cash on cash, a lot of other formulas. But to me, the capitalization rate is the key because it allows me to compare apples to apples to apples. Whether I'm buying a property in Houston, Texas, or Hollywood, California, or Henderson, Nevada, doesn't make a difference, or Chicago, Illinois, where my home is. If I know the capitalization rate and I have all the correct numbers, and there's the secret. You've got to do a lot of due diligence when you're analyzing a real estate investment because many of the calculations that people put into the MLS or bring up are not correct. I learned something a long time ago as a real estate investor as I look at properties. Figures don't lie, liars figure. They don't put in a vacancy factor. They average numbers. I've never had a water bill, a gas bill, or an electric bill that's exactly to the rounded dollar. Just like I can't go to the gas pump and pump exactly $20 in so it stops. I hold that gas pump with my hand like a surgeon, and I'm at 1992, 1993, 1994, 1995, 1996, 1998, 1999, $20.02. And guess what? For some people, that's only 4 gallons of gas today, maybe 6 gallons. We've got some inflation issues that this is the time. If there was a better time in the past couple of years, it's not going to compare to looking for property during an inflationary period of time and to leverage as much of the money as you can. We're not going to spend a lot of money talking about how to find money, but money is not an excuse. I don't have the money. You can find the money. You may have to pay a higher price for the money if you don't have a good credit score, as long as you can make things happen. See, if I can buy any property anywhere that meets my cap rate and I can break even the first year, all the money coming in has to pay for all the money going out. Doesn't cost me a penny to own that property. I'm one rent increase away from a positive cash flow. So next year, or next month, or in 6 months, if I have month-to-month leases, I can raise the rents because I broke even to begin with. So strategy, tactic, look for a property where you can end up at least the first year with a break even before taxes. So you pay all your expenses using all the income. So you don't make any money on this, but you're building appreciation. That's the A. And because you are paying off loans, equity buildup. So look where we're at here. Just as our first time together, and hopefully next Friday we'll get into more depth. But look at this. Real estate is not the best investment in my mind. It's the ideal investment because it brings monthly income, monthly passive income. One of my students at age 20 took a seminar of mine 30 years ago. He said, I learned 3 things from you. 1, get a real estate license when you're 21. You already have that. 2, buy at least 2 income properties a year. And 3, create multiple streams of income. Now that's a strategy. We had dinner 2 years ago. He's 50 years old. He's 52 now. He owns 1,200 properties, all residential rentals, 1,200 doors that people walk into to live that pay him a check every month. This is the ideal investment. I have monthly income. I can depreciate 3.6% a year of the building value of all residential buildings. I get equity buildup as tenants are helping me make loan payments every month to pay off my loans. The properties appreciate, the rule of 72s we just talked about. And above all, I can leverage. Now, every one of you, I'm convinced, has your own little guts gauge inside of you about the risks you will take versus the rewards you can make. Every one of you has a guts gauge somewhere inside of you. The risks you will take versus the rewards you can make. Some people don't want to take a lot of risks, so they can't make a lot of rewards. Other people will take a lot of risk to make a lot of rewards. I am a risk taker. I'm willing to buy a property with none of my own money, totally borrowed, totally leveraged. Because to me, sometimes the equity is an ego trip. If you ever went to a buffet where they've got either hot soup or pudding, and what starts to happen, if nobody stirs the soup and it just sits in that bowl, and now you want some soup, there's this layer of funny stuff at the top you got to take off because it kind of got stagnant because it wasn't being stirred. Well, your financial success is to not have stagnant money. It's got to keep moving. I don't know if the word currency came from the word current, but I want to make sure my money's moving around, not being stagnant. That's why we have HELOCs. That's why as you build equity in a rental property, you can get a HELOC on that rental property and use that maybe to buy another property. But once again, your guts gauge may not be as far to the total as somebody else's. The risks you take for the rewards you will make. You have to make that decision. And if you got a partner in life, you really got to check that with them. I never recommend that people should jump into real estate investing using the home equity loans for their personal residence. That better be totally inspected and respected with your partners to make sure they understand what you're doing, because that's your home. But I would say, as soon as you feel your risk gauge, your guts gauge gets further along, maybe some of it could be done. So I might have 3 mortgage loans. I might have a first mortgage, I might have a second mortgage from a private party or from the seller. I could purchase money mortgage and a little equity money so I can come in there with none of my own money. The goal is very simple. Borrow as much as you can, pay it off as fast as you can. That's the secret. Borrow as much as you can and pay it off as fast as you can. Now, there's numerous ways to take that philosophy as you begin thinking about all this stuff I'm throwing at you. I'm putting a lot of stuff out there. And again, it might be a little bit too overwhelming, or you're already doing it and I reminded you, but it's underwhelming. Either way, this is the secret. It's really not a secret. This is the process that everybody should be doing. It's a secret if you don't do it or don't know about it. It's kind of like me watching reruns. People say, why do you watch reruns? Well, I haven't seen the show, so it's not a rerun to me. I'm seeing it for the first time. Whether it's all the Seinfeld shows, whether it's some other show that I didn't see when it was on 2 years ago. Now, something else up there intrigues me that I hope will intrigue you is because I never dreamed that starting this year I'd be talking more about inflation than I ever did. But we have an inflation unemployment trade-off. And we actually, back in 1982, when we had that inflation that was so high, we created a misery index. It was the inflation rate and the unemployment rate. And those of you that were selling real estate back in the early 80s know that the prime rate was not the 2 or 3% we're looking at now, or the 4 or 5 it could go up to in the next 6 to 12 months, depending on the Fed's actions. It was 21%, with an unemployment rate of 10%. That created a misery index. We've never brought that misery index yet. So we do know that our economy right now, as it inflates, unemployment should go down. The problem with unemployment going down and more people are working, they may not be producing. And so they continues the inflation. So there's been several economists and several banks have shared this information. Maybe you heard about it, that in 2021 versus 2022, if you were an hourly worker and did not get a $7 an hour raise from last year to this year, I don't care if you're making $12, they jumped you to 16. If you're making $22, they jumped you to 27. If you did not get a $7 an hour raise, which most people didn't, you should have been cutting back on spending. How do you tell somebody who just went from 12 to 15 or 15 to 19 or 20 to 26, I got a $6 an hour raise? Yeah, you're worse off. I just went to get some milk yesterday. I bought milk a week ago. The price went up 25% for milk at my grocery store, Mariano's, which is a Kroger chain. 25%. It was $4 last week. It's $5 today for 2 gallons of milk. And that's their sale price. They raised their sale price by 25%. And how many of you can go buy a half gallon of orange juice? It's 52 ounces. There's no half gallons of ice cream anymore. They're a quart and a half. So another way that inflation happens is that we don't raise the price, we shrink the quantity. The dollar menu at McDonald's is almost all gone. There's very few things there for $1. If you look at the price of their sandwiches, any other fast food chain. So we have inflation. Too many dollars chasing too few goods. There's an inflation unemployment trade-off. And by its nature, that's just what happens. So we should expect lower unemployment. But again, because people are not earning enough money to cover the cost of things, they're worse off. It looks like they've got more money. That's called by economists wage push inflation and price push inflation. And we're stuck with both of those now. Part of it's our issue with shipping and getting things because of COVID. But still, no matter what the reason is, the end result is still the same. So if there's too many dollars chasing too few goods, the dollar doesn't become that valuable anymore. If you want to read this in detail now that it's among us, go back and read about Germany's hyperinflation. Hyperinflation, where people would be running to the grocery store every day because they wanted to get paid immediately to run to the store and buy stuff before prices went up. And they show people, we have movies, we have pictures showing people running from work with a wheelbarrow filled with money. And they're running so fast, some of the money is blowing up, not even picking it up. They get to the grocery store, and in front of the grocery store are all these wheelbarrows lined up with money in them. And they all run to the store to buy stuff. And now they got to go back outside so they can pay for this stuff. And they go to where they parked their wheelbarrow that was full of money when they walked in. And guess what they find? The money's still there. All of it. Somebody stole their wheelbarrow. The hard asset was more valuable than the money. And that's the message I'd like to share today. We are in a phase that could be 12 to 18 months, depending on which economist you talk to. Economists are saying between 3 and 8 Fed increases between now and middle 2023. The first one's coming soon. My prediction, it'll be for 50 basis points, not 25. I think they really stopped this fast. So their first one might be a 50 point or 50 basis point, 0.5% interest change. And it's going to affect some of the short-term loans, might have hit mortgages right away. But we have inflation. We have too many dollars chasing too few goods. But that also means our prices are rising. And some of you saw that in marketers with multiple offers. Some homes got inflated prices. People were paying $10,000, $20,000, $30,000, $50,000 over the list price. I actually been teaching a course called Certified Multiple Offers Expert Designation, giving people a designation on how to negotiate multiple offers. Because as we hopefully see each other more, we learn about each other through emails or here. I do a lot of negotiation training too, besides wealth building. But yes, some people did inflate the price of houses. We had inflation before, we'll have it again. See, whether it's inflation or recession, we don't know how long or how high or how low. All we know is we have that part of the cycle of our economy. No matter if it's inflation or recession, you end up with the same problem. Somebody loses wealth, they're the transferor, and somebody gains wealth, they're the transferee. If there's any message today, besides all the skill sets to become a real estate investor, is to remember to be the transferee of wealth versus the transferor. That's an inflation, recession-proof strategy, where you're going to be at in the transfer of wealth. Now, as you look at this list, we kind of touched on several things. I'm not going to get into the real estate self-directed IRA, except to let you know that if that's a strategy you and your partners feel is important, or you want to share with your clients to sell more investment property to some of your sellers who have equity in their properties, that should be done by a professional who knows how to set those up. Not everybody can do a self-directed IRA. There's a lot of rules and regulations, just like it's hard to do a 1031 exchange all by yourself. You have to have a third party. So those are just topics that I'm not an accountant, I'm not an attorney, but I do know they are valuable tools to use great brains for. And that's one of my 10 commandments of wealth building. Hire great brains. You got to find the person that knows 1031 exchanges, that knows real estate self-directed IRAs. And now it might be people that know Bitcoin. There's actually now a course you can take from Paprocki to be a certified Bitcoin, I guess it's specialist designation in real estate. And there's Dogecoin, and some of you know more about that. But we had 2 sales last year in Chicago. 2 properties were bought with Bitcoin. There might have been others, but 2 we know about. We never even thought about that 2 years ago. So that world of how people buy is changing. There's a cryptocurrency seminar in May in Miami that some of you might even be attending for all I know. And it's going to, I think, relate a little bit to real estate. The point is, we have got a lot of opportunities. And whether it's money or whether it's Bitcoin, cryptocurrency, but that whole blockchain technology is not something you should shy away from as a real estate investor. Might have some benefits. But once again, it's kind of uncharted territory, so please be careful. Please be careful. We talked about the rule of 72s. Let's just remind you, it's a quick and easy rule of thumb to see how fast investments double. Take any inflation rate and divide it into 72. Now, it wasn't that long ago. We're looking at 4% inflation. 4 into 72 is 18. So it would take 18 years for that investment to double. Where now we're looking at 7.5%. It's only going to take about a little less than 9 years for that investment to double. So if we stay at 7.5% inflation, you could take a 15-year loan out on a property and leverage it, and that property will have doubled once and then doubled again. The $200,000 home becomes a $400,000 home, and then by about 15, it's going to be pushing close to $600,000 or $700,000. And you have used other people's money, and you got income from the tenant, and you depreciated the property according to IRS guidelines, and you were able to get some appreciation because of the Rule 72s. So I took this one step further because it's not that I don't want to wait to build wealth. I'd like to know what are some better options. So I look at the Rule of 115s. And my guess is nobody in this audience has ever heard of the Rule of 115s. That says if I take that 7.5%, and I'm going to do it right in my calculator now. If I take 115 and divide it by 7.5, the answer is 15 years. In 15 years, my investment tripled. At 7.5% inflation, my investment tripled, not doubled, tripled. So to me, I like the Rule of 115s as an investor. When will my investments triple in value based on the inflation rate? Now, at 6%, at 3%, takes a lot longer. So timing is everything, and I think it's fortunate that you are on today and realize that time perspective has caused you to have a much better opportunity to get into the system and build your wealth in a much, I guess you say, faster way more than anything else. So, let's review. Sorry about that. Hold on. I apologize up front. I'm used to Zoom and I'm used to WebEx, so StreamYard is something that I got to get used to where all the places are. So let's give you a couple quick ideas in the process. Again, transferring wealth, we said, is the transferee is the one receiving wealth. Somebody will be selling their home, their property, because they have to. They can't make payments. There could be other issues. If that's the property that meets your criteria with capitalization rate, then you can use that. So what I'd like to do is just spend a few moments to finish up, giving you a bit of an understanding of what capitalization is in Wayne's World. Because I can read books, I can read chapters, I can find information on the internet, and many people make capitalization rate much more complex. So in Wayne's World, you're welcome to write this down. A short pencil is always better than a long memory. Write this down, please. Capitalization rate is the return of and return on an investment. It's that simple. It's a return of and a return on an investment. What's that mean? That means you just inherited $300,000. And you say to me, I want to buy a property. I want you to manage it. I trust you. So we manage the property, and you say, I want a 10% capitalization rate. That's my criteria. I want 10% income from my investment, and I want 10% return on my investment, a return of and a return on. So you pay cash for this property because capitalization rate calculations are based on paying cash. Doesn't mean you pay cash, it just tells you the cap rate to compare every property to every property. So at the end of the first year, I bring you an envelope that's got $30,000 in it. I paid all the bills for you. I paid my management fee, and you got an envelope of $30,000. You gave me $300,000. You wanted a 10% return on your money. Here's your $30,000. But you can't have it. We put it in a safe deposit box with number 1 on. Next year, we do the same thing. The end of the year, I bring an envelope with number 2 on. Inside of it, $30,000. Another year where you made 10% on your money. You gave me $300,000. Instead of going into a CD or money market fund, you bought real estate and you got $30,000. But you can't have it. We did it year 3, year 4, year 5, year 6, year 7. We keep doing that all the way until year 10. We go to the safe deposit box. I bring you the envelope with the number 10 on. You open it up. Inside, once again, $30,000. But you're getting kind of tired of coming every year to get the envelope to see $30,000 that you can't have. So this time I say, I got a surprise for you. Take all the other envelopes out of the safe deposit box. And now you got 10 envelopes on the table. You know how much is in each envelope? $30,000. Open them all up, and there it is, a pile of money that's worth $300,000. You just got all your money back, and you still own that income property. Every year that you owned it, you got a 10% return of your investment and a 10% return on your investment. That's a capitalization rate. Now, if you wanted 12%, you wouldn't pay as much for the property. If you wanted an 8% cap rate, you'd pay more for that same property. And so the one thing that you may have to at least believe I'm saying is true is that there's an inverse relationship in real estate investing. Inverse means opposite. An inverse relationship between the cap rate and the value of a building. So if you want a higher cap rate, you won't pay as much for that same building. If you want a lower cap rate, you can pay more for that building. So instead of it paying off in 10 years, if you want a 12% cap rate, it'd pay itself off in a little over 8 years. You got more per year, so you got more of your investment back. It only takes you about 8.5 years. If you wanted 8% cap rate, it would take over 12 years, a little less than 12.5 years. That's still not bad. But the point is, capitalization rate is such a tremendous part of wealth building in real estate because it lets you compare apples to apples to apples to apples. Now, that $30,000 that was left over, maybe you chose to use that towards paying your mortgages. So you got $2,500 to use to pay for the mortgage loans on the building. If you use all of that up and it pays for the mortgages, then you broke even, as I said a while back. You made no money, but you didn't lose any money. So how you choose to use the money that's coming in from a return of your investment. Some people pay in cash and spend that money. Some people borrow it all and have a big mortgage loan. Some people use the combination of some down payment money and the mortgage loan money. The ideal goal would be to buy a property where you can break even the first year. As we said earlier, if you break even the first year, we've got things all set up to be just a nice way of having a rent increase the next time the leases come due if you're using leases, or on a month-to-month tenancy with 1 month's notice, raising rents to those people. We also took some time today to owning your own home doesn't make you rich, or owning a real estate investment doesn't make you rich, because if you have it all paid for, your equity is earning you $0. We joke about having all your money in a mattress. Well, if a person owns their home outright or owns the property outright, it's not using that money, their money's earning them 0%. That person who put $100,000 down, $100,000 condo investment versus borrowing $100,000 could have been earning maybe more money than houses were appreciating. Now, right now, that may change a bit. But the point is, realize the fact that, among other things, there's a lot of different kinds of wealth on the national average. And we're pretty high up in terms of where we're at, but we're not nearly as high as in a couple of other countries are, like Austria. But for all practical purposes, we have a lot of landlords and business owners that are managing or owning property that people are renting. I just wanted to share that stat to show you that we are still a pretty solid investment place. We looked at the opportunity cost of money. Why would I use my money when I can use somebody else's money? Why would I cut my own grass if I can make more money doing something else and let somebody else cut my grass? Opportunity cost of money is critical. Some people buy money and resell it. Those are people that are selling money. Hard money lenders, they buy it at 5 and sell it at 10. You can buy it at 1 or 2 in an equity line and use it. Instead of borrowing at 4, you're borrowing at 2 because you use the equity in your income properties, or if you're comfortable using some of the equity in your home. Once again, I don't encourage the personal home residence as the first place to look for this process. And one of the other things we looked at is, again, and I want to leave you with this thought. I'm not here to say you shouldn't own everything and have a lot of equity. I'm just saying borrow as much as you can, pay it off as fast as you can, and use it as often as you can. I try to keep my money moving so I don't have that stuff on the top of the soup or on top of the pudding that kind of dries out, or the soup. So you have to realize what your guts gauge is. And if you are safe, then you will have a lot of equity. If you're more risk taker, you won't have as much equity, but you'll have cash flow and you'll have appreciation using other people's money. Now, I have taken almost 57 minutes of your time. I talked at about 250 words a minute, it gusts up to 500. So I'm hoping every single one of you will at least send me an email or leave me a text message in terms of something you'd like me to share with you that would make sense personally now that I've aroused your curiosity, maybe kind of stirred up your imagination, and can help you make that first step of awareness, and then the second step of setting the goals, and then realize I can't put this off. I got to do this. This is way too powerful because of the tax benefits, because I sell real estate. See, once again, if you're not investing in the stuff you're selling, are you really that believable? Blows my mind. The guy wants me to buy a BMW and he drives out at the store in an Audi. He wants me to buy an Audi and he drives out of there in a Mercedes. Or he wants me to buy a Ford, but he drives a Chevy. Well, if you're driving a Chevy and not a Ford, why are you trying to sell me a Ford? So I always believe more in people that buy what they sell. And so if you're selling real estate, my God, you should be buying real estate. With that said, I think we've reached that point where we're going to say goodbye or take a few questions. Anybody care to shout something out? Well, this was my first. I'd also appreciate a quick note in the email of how you felt about what I said and what you accomplished by listening, and any ideas for improvement in the process. So with that said, please make a commitment. So by the time we talk in a few months, you're telling me a success story of what you did buy, whether it's your first one or your 21st one, you made a commitment to buy something in the process. Until next week,